Good afternoon, everyone, and welcome to the first series of the Wealth Academy series we'll be running at Rand Swiss. This has just started now, the webinar, so we're just going to give it about 10-15 seconds just to allow everyone to join, and then from there, we'll get right into it. Just so you guys know, this is obviously recorded, so if you guys do have to jump out or anything, this will be uploaded to the YouTube channel, where you guys then can jump in and listen. But yeah, we'll just wait for everyone to jump on. And also just so you guys know, this is the paid version of Zoom, so just now security preferences here. If there are any technical difficulties, please just pop me a question. I'm more than happy to share it. So just unpacking the series. So we decided to do a Wealth Academy series purely for the reason that I remember when I first joined the industry quite some time ago, the number of products out there was insane. You have tax wrappers, you have tax-free savings accounts, you have retirement funds, you have unit trusts. Now, to try to understand the different regulations and the processes around it can be quite complicated. So the Wealth and Advisory team here at Rand Swiss decided it would be quite useful to start a series to unpack these different topics and allow our clients to sit in and just help them understand the different accounts out there. Now, I'm pretty sure you guys are quite familiar with the brand Rand Swiss, but I'm quite a new face to the companies. So just a little bit of background on who I am. I'm Furlong, I'm a CFP, and I'm one of the wealth advisors here at Rand Swiss. And what a journey it's been so far. It's myself and Yaku, who are the two wealth advisors, and we heading up this division for Rand Swiss, trying to obviously assist the clients when it comes to all wealth and advisory questions you may have. If you do check out our websites under the Wealth and Advisory sections, you can see the different services we offer. And both myself and Yaku would be more than happy to assist with any queries or questions you guys may have. So in terms of the agenda for today, the topic is going to be tax wrappers. I'm pretty sure with the subject headline, we did get lots of intake with this webinar because people don't like paying tax. People would like to reduce that tax liability. And that's exactly what we're going to unpack today. So just in terms of the agenda, we're going to unpack just a little bit of a history of the structure, a little bit of a history around how there's been quite an increase in capital gains tax over the years. We're also going to unpack a little bit of the mechanics around the investments, touching on the contributions, the liquidity, the tax benefits, and the estate planning side of things. And then we're going to finish off with a case study where we look at a real life example on why use a bank account when you could be using this structure to help reduce your tax bill for the next financial year and financial years forward looking. So just touching on a bit of a history and structure of this and the history of CGT. A little bit of history on the structure of tax wrappers is historically they haven't been viewed in the best light. And they haven't been used so much, and understandably so, because in the past, these products typically had very, very high fees. Additionally, there was a bit of an association with life companies. And the problem with that was that if you ever stopped contributing or you had to do some early withdrawals or there was some change that wasn't in the original set of agreements, there would typically be penalties attached to that. And those penalties would greatly reduce the capital value. On top of it, there was an extreme lack of liquidity within these products. So essentially what that means is if you put in money in this product, and after 2 years, you want to access the money, you often couldn't. There was often rules around it. So in the past, these have not been viewed in the best light, and understandably so. But what's nice is obviously as the competition has increased in the administrative platform landscape, there's been great changes to these products, and hence why we're starting to actually see a bit of an influx with them being used. Additionally, if we look at the history of capital gains tax, there's been a huge change over the years. So what we can see from this graph over here is that from 2003 to 2011, the CGT rate, the capital gains tax rate, was quite sustainable for many years. So essentially what does capital gains tax mean is it means that you have to pay tax on the growth of your investments. So we'll use quite a simple example to get started. If you buy a share for 100 Rand, if you buy a stock for 100 Rand, and you then make 100% profit on it, so then you sell the stock for 200 Rand, there was a capital gain of 100 Rand. What that means is the government says, no, you can't take the full 100 Rand profits. You have to pay tax on that. Now, in the past, like you can see from here, is the capital gains tax was not too aggressive in the past. So you can see there, like I said, from 2003 to 2011, was quite stable. And typically why these products weren't used in the past is because the black line illustrates what an individual would pay in terms of capital gains tax, and the red line illustrates what the individual would pay within a tax wrapper. And you can see there was only about an effective rate difference of about 2.5%, because what we can see from here is the inclusion rate was 30%, and the marginal rate was the inclusion rate was 25%, and the marginal rate that was being used here was 40% for individuals and 30% within a tax wrapper. But then after the 2010 World Cup, I think government realized they maybe had a bit of overspending, and they wanted to slowly increase the capital gains tax rate amongst individuals. You can see there's been quite a dramatic increase over the last decade, where the inclusion rate has gone up from 25% to 40%, where we find ourselves currently. And the marginal rate has gone up from 30% within, or it stayed 30% within wrappers. Before an individual, it went from 40% to 45%. So quite a meaningful difference. And what we can see over here is this is the effective tax rate. So what you can see that the current times we find ourselves in is that if you're an individual who's in the max tax bracket and you make a sale of that share, in the 100 Rand example we used, you can see there that you'll have to pay an effective CGT rate of 18%. So that means if you buy a share for 100 Rand, you sell it for 200 Rand, and that means you made a 100 Rand gain, 18 Rand is taxable. Where if you're in a tax wrapper, there's a 6% saving, and your effective CGT rate is only 12%. So you can see why in modern times, this is a highly effective product. Now, if we look at the mechanics of this investment, I'm just going to unpack how it differs from your normal flexible investment you find. So remember, what's very important when I talk about this investment, I'm referring to both local and offshore. This product is available both for South Africans and for if you want to invest out the country and utilize your single discretionary allowance where you convert your rands into a foreign currency. So if we look at a flexible investment, the key element shares is quite simplistic. Lots of advisors and clients like it, and understandably so because it is so simplistic. So if you look at contribution, what essentially that means is how much can you put in this investment. A flexible investment, it's a unit trust. You can put in money whenever you want. You can put in money today, put in money in 5 years' time, put in money in 10 years' time. There's no restrictions there. So we've given that 3 out of 3. In terms of liquidity, you can also put in money. You can take out money whenever you need. So liquidity with this account is very, very great. We've given that a 3 out of 3 again for unit trust. The problem is with such a simplistic vehicle is when it comes to complex tax, it doesn't offer those tax benefits. And that's why with tax benefits, we've only given it a 1 star. Now, reason why we've done that is because every single South African investor is given a 40,000 Rand capital gains tax allowance. So if you have a unit trust and you're within those parameters, you actually don't have to pay capital gains tax up to a certain amount. So hence why it does still have some degree of tax benefits, and we're giving it 1 out of 3. In terms of estate planning benefits, we think there's absolutely none applicable. So we've given it 0 out of 3. So essentially what that means is once you passed away and you allocate beneficiaries in accordance with your will, a flexible investment will be dealt with in accordance with your will. If we now compare to tax wrappers, these are very, very different. It has a lot more advantages on the tax benefit and estate planning benefit sides. So if we first touched on the contribution side of things, we've given this a 2 out of 3. Reason being is there's something called a 120% rule, and we're going to unpack that further in the slideshow. The next is liquidity. We've also given this a 2 out of 3, purely for the fact there are some restrictions in terms of accessing the capital. But again, I'll unpack that further in the presentation. In terms of tax benefits and estate planning benefits, we feel this is one of the best products out there. And that's why I've given it both 3 out of 3 stars for both its tax benefits and estate planning benefits. Now, when I talk about tax wrappers, there's 2 different sort of types you can get. And for some of you guys may be familiar with one or the other, but I'm going to unpack both. There's a sinking fund and there's an endowment. So it's very important to note is when I say tax wrappers, you can get one or the other, and this differs from product providers. And that's where we feel it's very, very valuable to chat to, a wealth advisor, because they can help unpack which one is more appropriate for you based on your unique circumstances. So what we can see here is both a sinking fund and an endowment have a 5-year term. So what that means is if you put in money, there's a 5-year term. I'll unpack in terms of how the liquidity and the contributions work with regards to that 5-year term. But what's very, very important is whenever you hear sinking fund and endowments, I want you to think of the term life assured. So what does that essentially mean? Is life assured, there's no life assured on the sinking fund, but there is a life assured on endowments. What that essentially means is with a life assured, the death of the last life assured is when there's a transfer of ownership. In terms of a sinking fund, there's no life assured. So when the policy owner passes away, the ownership goes directly to the beneficiary. Where with an endowment, you can have multiple lives assured, and when the last life assured passes away, the cash gets paid out to the beneficiary. So that's the key difference. It's more in terms of ownership. With a sinking fund, think of it as there's only real one owner. An endowment, think of it as there can be multiple owners, i.e. multiple lives insured. Now, when is an endowment practical for some people? We feel it's quite practical for like business owners. Reason being is they offer creditor protections after 3 years. That means if you set up an endowment and all of a sudden you have some creditors issues and it's after 3 years of the inception of the policy, that is completely protected from creditors. So creditors can't access that. Where sinking fund, that is still obviously, they can take that. So that's the one time when endowment takes the benefit. The time when a sinking fund takes the benefit is that there's a capital gains tax rollover on death. So essentially what that means is, let's just say I set up a sinking fund, I pass away and it goes to a beneficiary. Let's say in this case, it goes to Yaku, he's the beneficiary. And I put away 100,000 Rand, it's now grown to 200,000 Rand. He's the beneficiary. Now remember, with the sinking fund, there's no life assured. So he takes ownership of that. He takes ownership of the accounts and he will take ownership of that at base cost. So on a SARS perspective, they're going to view it as if he had the sinking fund to the value of 100,000. So there's no capital gains tax. But with an endowment, if I had an endowment, I'm the policy owner and I'm the life insured, and Yaku is the beneficiary, and I pass away. So remember, the life assured has passed away. The benefit will go to Yaku, but it'll be paid out in cash. And that is the one downfall with it in terms of the endowment. So again, a sinking fund and endowments, we're able to offer both to our clients, but it's very, very important to speak to a wealth advisor to find out which is more appropriate for you. And remember, these are available both local and offshore. Now, if we touch on the contributions, this is typically where clients do get a bit nervous with this tax wrapper because it is the more complex aspect of it. But I'm going to try to talk through it. And please, if you have questions, please pop them on the call. Alternatively, you can email either myself or Yaku. We're more than happy to obviously talk through it. But if we unpack contributions, there's a thing called the 120% rule. And it sounds quite complicated, but hopefully after understanding this, it just breaks down a bit easier. So if we look at scenario one, there's the model citizen. This is your sort of best approach when attacking this 120% rule. So what happens is, remember I spoke on that 5-year term. So you can see in year one, you open in a tax wrapper with us and you put away 100,000. In year two, you can only put away 120% of the contribution from the previous year. So what that essentially means is in year two, you can't come to me and say, I want to put in 200,000 because obviously it exceeds 120% of the previous year's contribution. So what that means is in year two, the max you can contribute is 120,000 if in year one you put away 100,000. Then where it gets quite interesting is then in year three, because all of a sudden how you can contribute to that is you can only contribute the 120% max of the previous 2 years. So you can see in this scenario here, in scenario one, year one, the client contributed 100,000. Year two, they contributed 120,000. In year three, they want to know how much they can contribute. They can contribute 120% of the higher amounts for the previous 2 years. So in that case, the higher amounts was in year two with 120,000. You take 120,000, you times it by 120%. The max amount they can contribute is 144,000. And obviously they can continue doing so throughout the period of the investment. Now, if we look at scenario two, this is average Joe. And what this means is that he contributes 100,000 in year one. In year two, he contributes nothing. In year three, he comes to us as the advisors and he say, what's the maximum I can contribute? What we do is we look at the previous 2 years and we say, well, in year one, you contribute 100,000. In year two, you contribute nothing. So the higher amounts between the two was in year one, where you contribute 100,000. Therefore, you can only contribute 120% of the previous 2 years. So in year three, the max he can contribute is 120,000. In year four, he doesn't have to contribute anything. In year five, again, we look at the previous 2 years. So in that case, we look at year three and year four. and there you can contribute 144,000. In scenario 3, we have almost the rebel in this case. And we can see here, he put away 100,000. In year 2, he put away nothing. In year 3, he put away nothing. Now in year 4, the client comes to us and they say, I want to contribute to this tax wrapper. The problem is if you look at the previous 2 years, he's contributed nothing. Now, what's 120% of nothing? That's nothing. So therefore, he can't contribute to this tax wrapper again because of the previous 2 years, he's contributed nothing. So that's just something to be aware of when it comes to the contribution rule. So we typically like to recommend when clients do want to set up tax wrappers, just understand a sort of forecast for this. What is the time horizon? Are they going to contribute for 1 year and not again? Or are they going to contribute for a continuous basis? Again, if you are going to be the sort of client that's in scenario 3, that's perfectly fine. But just understand that obviously the restriction is limited with the 120% rule. So it's just something we want clients to be aware of when setting this investment vehicle up. Now, liquidity. Now, you'll remember from the previous or one of my earlier slides, I spoke about how historically in the past, investors didn't like this product due to the big liquidity constraints within it. What's nice to see is, like I said, as the competition has increased across admin providers, they've really increased the liquidity you can get within this investment within the 5-year term. So in terms of liquidity within the first 5 years, there's 2 different ways you can access the funds. The first way is you can do a withdrawal. So remember, if you set up a unit trust with different investment platforms, you put away 100,000. After 3 years, you say, when you cash in an investment, you can cash in the full amount plus market growth. In this case, it works very similar. And what you can do is you can do withdrawals. Now, it's very important to know here is I said 100 underlying policies. This differs again from product provider. So we partner up with the top 4 different product providers. So we've partnered up with 91, Momentum, Allen Gray, and Sanlam Glacier. So when it comes to this, it's again very, very important to speak to the wealth advisor because among these different product providers, there are slight differentiations when it comes to the withdrawals and when it comes to the loans. But one of the ways you can access the funds is through a withdrawal. And that is simply you call the advisor and you say, listen, I've put away money. I now want to access a portion of it. You submit a withdrawal request. Within 5 working days, the money is paid into your bank accounts. Quite simple. And in terms of the 100 underlying policies, what some of the product providers have done, which is quite unique, is they've opened one account with 100 underlying policies, meaning that within the first 5 years, you can access 100 different withdrawals, which makes the liquidity a lot more beneficial. The other way you can access the funds is what's known as an interest-free loan. Now, typically when I say loan to clients, people think, well, why do I need to take a loan from you guys when I'm giving you the money, when I'm giving you my cash? Don't view it like that. It's not a liability on your guys' balance sheets by any means. It's not like you owe anyone money. It's purely a very unique way we can encourage more contributions to the investment. So essentially what the loan means is if I open up a tax wrapper, I put away 100,000 in year 1. And remember, looking back at that 120% rule, I don't contribute for 2 years. So on year 4, I actually can't contribute to this tax wrapper anymore. Because remember, of that 120% rule of the previous 2 years, I've put in nothing, so I can't put in nothing going forward. Now I then contact my advisor, I contact Jaco, and I say, listen, I want to access the funds. He says, okay, there's 2 ways we can access it. The one is with a withdrawal. But he will more than likely recommend I take a loan. Why do we prefer a loan? It's because I can withdraw 100,000 Rand as a loan. And then in 3 years' time, I can repay the loan. I can put in the money back into the tax wrapper, even though it's not considered a contribution, it's considered a repayment. So a loan is a very, very unique way, and it's a very nice addition to tax wrappers. Because what it allows people to do, it allows longevity. Because now all of a sudden you can put in money, you can take money out as a loan, and you can repay that loan over a various period of time. You aren't restricted with that 120% contribution. And that's where we've seen a huge demand for these products, because typically in the past, people have liked trusts because there's that longevity amongst them. This offers that with the feature of a loan. And there's 4 reasons we love the loan. One is because it allows you to provide for future need. So let's just say I get a huge lump sum as an inheritance. I get 5 million Rand inheritance. Now I want to open up a tax wrapper. I can put in 5 million Rand. After a year, I can loan 3 million rand from that. So my balance on the investment is 2 million, but my loan value is 3 million. And after 10 years, I can repay that. Once I have more liquidity, I can repay the 3 million rand loan. And all of a sudden, I have a tax wrapper that has 5 million. The next is supplementing income. So what we've seen typically with our retired clients is they have a pension or a preservation or retirement annuity, and they retire from that at age 55 onwards. And then they put the remaining amounts into a living annuity. So a living annuity is a sort of product that pays people who are retired an income every month or however often they want to select it. The problem that we have with living annuities is that is taxed at your marginal tax rate. So every time a living annuity pays you an income, you get taxed in accordance to the income tax tables. And the downfall there is obviously the marginal tax rates can increase. What's nice about this is this can supplement income in retirement. So what I mean by that is you could have a pension, which you retire from, and then you have a living annuity, which pays you an income. The more income you get from that living annuity, the higher your tax bracket. Where what we can do with this is, remember, it's a very, very tax efficient vehicle. We can have some income being paid out as a loan from the tax wrapper, and then you don't have to withdraw as much from the living annuity, making your living annuity income reduced. The next thing is the loan value is transferable. So what do I mean with that? Is remember with this, these are very effective also from an estate planning aspect. So if I set up a tax wrapper and I put away 5 million, and I take out 5 million via a loan, there's essentially no balance in the accounts, but there's a loan balance of 5 million. And I pass away, and the tax wrapper goes to my beneficiary Yaku. Yaku then has this tax wrapper, and he has the loan value transferable. So that means he can put in 5 million in this tax wrapper, repaying the loan. So that's quite a nice aspect of it. And then finally, they can be used in perpetuities. They can be used forever. So that's where it's a nice alternative to a trust, because this can be transferred across generations, really allowing for generational wealth. Now let's get to the good parts of tax benefits. Essentially, we've all obviously done our tax returns recently, and we've all, like I said, been very, very disappointed to see an RT3B come across and an RT3C. What does that essentially mean? Is an RT3B is due to income tax, and that can be high as 45%. When RT3C is obviously related to capital gains tax, and that can be high as 18%. What's nice about a tax wrapper is you are effectively swapping your tax position with the policy. So you'll notice as an individual, you can be taxed up to 45% on an income tax level. And in capital gains tax, like I said, you can be taxed up to 18% on an effective CGT rate level. With the tax wrapper, this is all taxed within the product. So all of a sudden, if you set up this investment, there's no RT3B being issued and there's no RT3C being issued. And as an investor, especially for your more high net worth individuals, you don't want to get this because it just means more liability to SARS. If you have a tax wrapper, all the tax gets taxed within the product. You don't have to ever worry about it in your individual capacity. What's nice about it is also the reduced tax amounts. You can see here on an income tax level, your income tax is reduced or is capped at 30%. So you can never, ever get higher than 30% income tax within this product. So if you open up this product and you put in money in it, your income tax is capped at 30%, even though on the individual level, you could be in a much higher tax rate. The second benefit is on a capital gains tax level. The capital gains tax is capped at 12%, versus in your individual capacity can be as high as 18%. So a 15% tax saving on an income tax level and a 6% tax saving on a capital gains tax level. What's nice about it is, again, you swapping your tax position. So whenever you think of a tax wrapper, view it as it's not in my name anymore. It's in the tax wrapper's name. So it's completely separating you and the tax wrapper. And this is very, very useful for lots of clients. I mean, we've seen lots of clients now immigrating. Now, when it comes to immigration, it's impossible to know the tax laws with all the different countries out there. What's nice with this is, remember, you now are completely separated from the tax wrapper. And tax wrappers can be available offshore. So if you want to use your single discretionary allowance, you want to take R1 million out the country, convert it to another currency, and let's just say dollars, you can open up a dollar-based tax wrapper, and that can be used if you do plan on immigrating, and you know for sure what your tax position will be. So it's nice for certainty level. The final point is estate planning benefits. We feel this is a great product when it comes to estate planning. So what we've looked at here is now we're looking at an offshore example, and we're looking at a client that has $100,000 and they've invested this, then they've put their $100,000 in a tax wrapper versus if they had their $100,000 in their personal capacity. So in terms of this, the red line is the tax wrapper, and the black line is if you had this in an unwrapped product, so like a flexible investment offshore. So what you can see from this illustration is the client here has $100,000, and after 5 years, they pass away, and they have their spouse as the beneficiary. So now just taking on my CFP hat and talking about some sort of estate planning things, when you pass away and you hand over all your assets to a spouse, there's a Section 4Q abatement. So what that means is that you don't have to pay any estate duty when all your assets get transferred to your spouse, which can be 20% or even as high as 25%. You don't have to pay any capital gains either because it's between spouses. If it's between other parties, those are triggerable. But what we can see from here is the policyholder passes away and they hand over the benefit to the spouse. What's nice about this product is you can nominate a beneficiary. In this case here, they've nominated their spouse, so there's no need for an executor. Now, if you didn't have a beneficiary nominated, the executor would have to allocate who gets the funds, and there would be executive fees payable. We've typically seen when people do wills through various organizations, executive fees can be quite high, and sometimes as high as 4.025%, inclusive of that. So all of a sudden, what you can see from this example is a client has 100,000, they pass away. Within this product, there's no executive fees payable, and there's no estate duty payable or no capital gains tax payable if it's going to their spouse. If they didn't have this structure, they would all of a sudden, you can see the drop off there by 4%, and that's where the black line, you see it, because there's executive fees payable. Now we're there compound for the next 10 years. And you can see, obviously, as that 4% is being compounded, the gap has been more and more increased. And now let's just say here, the spouse dies, and they hand over the benefits to their children. Now you'll see there's quite a big drop-off, but a much bigger drop-off with an unwrapped policy versus a tax wrapper. So why is there a much bigger drop-off? Well, because all of a sudden there's 3 fees payable. There's executive fees because the executor now needs to say, okay, you had this investment, we now need to give it to your children, but they're taking a 4% fee on that, typically. Then there's estate duty. Estate duty, like I said, can be 20% or even as high as 25%. And now all of a sudden there's 25% off that investment also. And then there's capital gains tax, because remember, you've put in 100,000, you've made probably about 220,000. SARS is not going to say, perfect, you can give it to your children. They're going to say, you have to pay capital gains tax. And all of a sudden, there's quite a big knock in terms of the investment value. Where with regards to a tax wrapper, the only thing you have to pay would be estate duty if you keep it within the product. So if the spouse dies and they hand over the investments to their children, the children are listed as the beneficiaries. So there's no need for executive fees. Also, the children are going to keep the policy, and there's what's known as a CGT rollover. There's a capital gains tax rollover because there is no capital gains tax events. The only thing that would be payable is the estate duty. And now you can see, once the children have had the policy for 5 years, in this example, the difference is huge when it comes to the tax saving on death. Where in our example here, the tax wrapper, the final value will be $266,000, where if they didn't have a tax wrapper, the value would be $209,000. So quite a significant difference between the two. Obviously, it alludes back to that point that dying is very expensive when you're handing over your assets from one party to another. But if you structure it correctly, it really can reduce that rate. And that's where obviously we would highly recommend you obviously speak to an advisor prior to ensure that this is quite a useful product where if you have beneficiaries, you can hand over the legacy quite nicely. Now, obviously, we've unpacked quite a lot in this. We've unpacked the contributions, liquidity, tax benefits, and estate planning benefits. And I've spoken very broad-based. Now, I'd like to maybe relate it to a case study to make it quite practical for our audience. So in this example here, we have Gary Boyson. He's the director of Rand Swiss, but what we're going to make the assumption here is he is a business owner. And I thought I'd make it a little bit more interesting. He is actually a farmer in this case. So he's a farmer and he's had quite a good year with harvests and he's made 10 million Rand. Now, he comes to some advisors out there. He says, listen, guys, I've made 10 million Rand. I am a farmer, so there is going to be quite, I need the liquidity potentially in like about a year or in a year and a half's time. So as the advisor, we immediately look at his risk position and we say, we can't put him in the stock markets because the stock market is way too volatile for with a year period. So we say, okay, well, potentially you don't have the sort of time horizon to be in the stock market, maybe go into cash. That's what some advisors would say. So he does. He sees that the bank is offering quite an attractive, interest rates are quite high. You can get 10.5% with some sort of like maybe a 1-year term. So he thinks, fantastic. I'm going to take my 10 million Rand. I'm going to put it all in the bank in my personal name. And that's fantastic. He's getting that 10% effective rates. What's the downfall is, like we've all seen, tax returns come, and 12 months later, he gets whacked with a nasty RT3B certificate from the bank, where he's now made a 10% growth. Now, what's the problem with this? Is that now he's getting taxed in his personal name. And in the assumption here, he's in the highest possible tax bracket of 45%. So what that means is that he's actually not getting a real return of 10%. The 10% return is before tax. Remember, you need to pay tax on that. So essentially, once you take tax off, he's only getting 5.78% return. So a huge drop off. So then what happens is then I actually don't think if an advisor recommends this, they're actually doing their job because they haven't really added too much value to the client. Because in this case here, Farmer Gary had 10 million Rand. He had a very short time horizon of only 10 months. The advisor recommended that he put it in the bank. He ended up getting whacked with tax. He only made a 5.7% growth. He cashed it in and he walked away. Where what I want to recommend is I'd like to look at his individual tax position. I'll say, listen, Farmer Gary, you're in the max tax bracket of 45%. Let's recommend a much more tax efficient vehicle to obviously ensure greater growth. So what I would recommend is potentially a tax wrapper in this case, which is obviously what we've discussed here. And what's the benefit of having a tax wrapper is there's ultimately lots of different underlying holdings you can do. At Rand Swiss, we are Cat 2 business. So what that means is we're able to open up a tax wrapper for clients. And if they want to be invested in the stock market, either locally or offshore, we can open up a direct stock portfolio for them within a very efficient tax structure. Or we can even look at doing our new, so we are launching structured notes. Our structured notes now that's been released as an auto call. We could even open up a tax wrapper for our clients, make the underlying holding be the auto call, and that's a very tax efficient way to do this. But let's just say in this aspect here, Farmer Gary said to us he doesn't have much time because obviously with these farmers a good harvest, he may need the liquidity in 12 months' time. So we say we're not going to put you in a stockbroking portfolio or an equity portfolio. We're going to put you in a much more reduced portfolio. And in this case here, we want to maybe use the Peregrine Capital Pure Hedge Fund. Why we like this fund is, again, it's very, very low risk, never had a negative year since their inception. So what we put in here is we put them in that fund. Now, based off their fact sheet that I looked at this morning, which was up until the 30th of September this year, the average annualized 5-year return was 10.7%. But to make the example easier, we're just going to look off the same return of 10.5%. So it's a direct like-for-like comparison versus the bank. All of a sudden, a year surpasses, and there's no RT3B being issued. There's no RT3C being issued. So SARS, actually, he does not owe SARS anything when it comes to this investment here, because remember, it's taxed within the product. And what's the benefit? Remember, income tax is capped at 30%. Your capital gains tax is capped at 12%, completely separating you and your individual tax capacity. And then all of a sudden, the net return he's getting in this case is 9.24%. You can see a massive difference in net return based all on tax. So that's one thing. For your high net worth individuals, You don't want an RT3B. You don't want an RT3C. You want to completely separate you and the tax position. And that's what this product is able to do. So in this case here, we open up a tax wrapper for Gary. Now, lots of people are looking at me and thinking, wait, hang on, Carl. You spoke about this liquidity constraint. What happens now? I'm not going to put in money in a tax wrapper if I need the money 12 months later. But in this case, you can, and I would recommend you use the loan. So why do I like the loan? Well, remember, you can now put in, Farmer Gary puts in his 10 million Rand. We put him in a very, very low risk investment, and now he wants to access the cash. We then do a loan, and he can take that full 10 million Rand out, plus the growth, up to 5%. Now, he takes that out. All of a sudden, the product providers then send him quarterly statements every quarter where they say, Farmer Gary, your balance is 0, but your loan value is 10 million. Why is that so practical? It's because remember now that there's that 120% rule. So let's just say in this case here, Farmer Gary sets up this product. He then puts in 10 million. He takes out a loan 12 months later for 10 million. And he doesn't contribute it for the next 10 years, let's just say. Every single quarter for the next 10 years, either 91 Momentum, Alan Gray, or Sanlam will email Farmer Gary and they'll say, Farmer Gary, you've got a balance of 0, but you've got a loan value of 10 million Rand. And then what that means is, let's just say in 10 years' time, Gary has another great harvest and he's got 10 million Rand again. He can repay that loan. So he can then all of a sudden put the 10 million Rand back into this mature tax wrapper, getting all the tax benefits and allow for this, obviously, this product to take place. And that is one of the biggest benefits around it. And also remember, in one of my first slides, I spoke to you about typically in the past, the fees were very, very high with these products. What's nice about this is if you have a balance of 0, the product providers charge you on the balance amount. So in this case here, Farmer Gary would actually be paying nothing for having this account open because the balance is 0. He won't be paying the balance on the loan value. He's paying on the balance. So that's what makes it very, very practical. Now that's on and this is obviously applicable to various different business owners, various different clients. But again, chat to your wealth advisor before to obviously understand, is this more suitable based on your unique circumstance? That's on a very, when you live in. Now, when you get to a little bit more of a morbid topic, this is now on a death event. So again, in this case here, we've seen a plenty. I mean, there's billions sitting in the bank. And we don't understand that because there's various negatives behind it. You're paying high tax on it. And also on the estate planning aspect, it's not very appropriate. So in this case, yeah, we look at a person that's got 10 million Rand and they have a bank account. It's sitting in the bank account. Now, what's the biggest concern around this is especially in the fact if they have children or if they have a spouse that depends on them for income. Because what happens here, and then there's the other alternative is they have a tax wrapper. So now there's a death event. So let's just say in this case here, the client passes away. They have 10 million Rand in the bank account, earning after-tax amounts of 5%, which isn't even being inflation. The concern here is that once they pass away, this then goes in their will. And the concern we've seen a lot lately, and obviously we've seen it more and more in recent years, is winding up estates is taking longer and longer and longer. And the problem is before the estate is wound up, the money gets frozen. So in this case here, if the client passes away with 10 million Rand in their bank accounts, all of a sudden that money is completely illiquid. So their spouse and their children don't have access to those funds. Now you can imagine all the different fees that may be payable when someone does pass away. That is completely frozen. That 10 million cannot be accessed by the spouse, or it can't be accessed by the children, obviously, in this time. The second thing is you're also going to get whacked with executive fees. So if you pass away with 10 million, the executor is going to come and they're going to say, you can't nominate a beneficiary. We're going to take 4% of this 10 million and we're going to hand it over to your spouse in accordance with your will. Now, that's obviously not very appropriate. A tax wrapper in terms of death is a lot more appropriate when it comes to efficient estate planning. Because all of a sudden, remember here, when you have a tax wrapper and you nominate a beneficiary, when you pass away, there's an immediate change of ownership. So all of a sudden here, in this case, the client passes away. Immediately, their spouse becomes the owner. So immediately that money is liquid. They can immediately access the funds. They can immediately withdraw. They can immediately take the loan. Also, what the benefit is remember what's very important is the term falls away upon death. So if you open up a tax wrapper today and you put 10 million and you pass away tomorrow and your spouse is the beneficiary, your spouse gets a mature tax wrapper immediately. The other benefit is there's no executive fees. If you pass away and you've nominated a beneficiary, there's no need for an executive to be involved, therefore saving executive fees. And the second is there's no capital gains tax, because remember, there's a capital gains tax rollover. If you have 10 million, it's growing now to 15 million, and you have your children as the beneficiaries, and you pass away, and your children get the investment. They then get the investment. They become owners of that investment. They don't get the cash. It doesn't get paid into their bank accounts. They get the ownership of this account. The benefit is they get it at the base cost of that investment, making it highly practical. Another example is if you then take a loan. So let's just say in this case, the client has 10 million Rand in the tax wrapper. They take 5 million Rand out. So remember, there's a balance of 5 million and there's a loan value of 5 million. And now they pass away. And now their son gets the benefits. The son all of a sudden gets the account with 5 million Rand, and they also they have a loan value of 5 million Rand. So if the child in this case is doing quite successful in their own right, they can take their 5 million and put it in this matured policy, making the balance go to 10 million. They don't have to worry about their 120% rule not being followed. So that's obviously the benefits with this, and that's just a little bit of a case study saying, we don't understand why in certain aspects. And when I say bank accounts, obviously we're not saying get a tax wrapper if you need, your debits to come off, if you want to do it like that, then it's not very appropriate. It's more for the fact, don't keep money in the bank if you have, if you want to maybe use it in 12 months' time, or if you do have children or dependents that may need the capital, because it does become very illiquid. Now, finally, obviously, it's just some questions and answers. I'll take a look at some of the questions that have been sent, but ultimately, both myself and Yaku's email address is there. So if you do have any questions, please feel free, pop us a mail. I'm more than happy to obviously talk through them. But just obviously looking at some of the questions that have been sent. So one of the questions now, what is the average fee for the tax wrapper? So with regards to this, what we've seen is that there's ultimately many different sort of fee structures that can be used. In the past, the fee structures were quite high. They went up to about 1%. Like I said, it's been very, very competitive now, the industry, and the fees have greatly reduced. So the entry fee now for a tax wrapper is 0.5%. But what's nice is that the bigger your capital, the bigger your funds are invested, you get a fee reduction because it's based on a sliding scale. So the lowest fee possible on this, on the top tier of the fee scale, is 0.1%. So if you have, let's just say like 3 million plus, you can then get 0.1% fee on this tax wrapper. And that's where we've seen a lot of demand for it because, back in the day, local trusts were quite an effective sort of structure for high net worth clients, for clients who want to ensure succession. We find, a tax wrapper is a much more affordable structure for clients that can offer the same tax benefits and that can offer great succession amongst clients. So that's just obviously with regards to that. Guys, I haven't got any other questions. So please, if you do have any, feel free to pop myself or Yaku a mail, and we're more than happy to, talk through it further. But for all those who have attended, thank you so much. I really appreciate the time. And also just, to welcome myself as one of the wealth advisors. Like I said, I've joined Rand Swiss now this year. It's been a great move so far. And looking forward to the journey ahead. Thank you so much for the time, guys. Have a great day.